Right now, at this exact moment, there is a war happening. Not in some distant country. Not on some battlefield you will never see. On your screen. Inside your trading platform. In the space between the moment you decide to enter a trade and the moment that trade either makes you money or takes it from you. And for most traders, the overwhelming, devastating majority, that war has the same outcome every single time. They lose. Not because they are stupid. Not because they lack dedication. Not because the market is impossible to trade profitably. They lose because they do not know the rules of the war they are fighting. They show up to a battlefield armed with indicators and strategies and tutorials, facing an opponent that has been fighting this war for centuries, and that has developed, over those centuries, a set of psychological traps so perfectly engineered that most traders walk directly into them, over and over, without ever realizing they are being manipulated. This article is going to show you every single trap, every psychological trick, every mechanical manipulation, every pattern of market behavior that is designed, whether by nature, by institutional players, or by the pure mathematics of crowd psychology, to separate you from your money. And then, more importantly, it is going to show you exactly how to beat every single one of them. Read every word, because what you are about to learn is not theory. It is the difference between being a victim of the market and being someone who profits from it. Trick #1, the false breakout, the market's most profitable deception. Picture this scene. You have been watching a stock, a currency pair, or a crypto asset for days. It has been building up against a key resistance level, a price ceiling that has held firm multiple times. Every time price approaches it, sellers push it back down. Then, one morning it happens. Price surges through that resistance level. It breaks out. It closes above the level that has contained it for weeks. Everything you have been taught tells you this is it. The breakout has occurred. This is the moment to buy. You enter the trade with excitement and confidence. And then, with almost supernatural cruelty, the market reverses. Price falls back below the breakout level. Your stop loss is hit. You take a loss. You have just experienced the false breakout, and you are far from alone. Here is what actually happened. That breakout was not organic buying pressure. It was, in many cases, a deliberate act by institutional players, large funds and trading desks, with the capital to move markets temporarily. By pushing price above a key resistance level, they trigger the stop losses of traders who are short, and simultaneously trigger the buy orders of breakout traders who are waiting for exactly this moment. Both groups are now buying. This buying pressure briefly pushes price higher, creating the appearance of a genuine breakout. And while retail traders are piling in on the long side, institutions are selling their positions into that buying pressure. Once the retail buying is exhausted, there is no one left to push price higher. It collapses back below the resistance level. The institutional players are now short from above the level, and retail traders are long from the breakout, exactly where the institutions want them. How to beat it? Never enter a breakout on the initial candle. Wait. A genuine breakout will be followed by a retest of the broken level, which now acts as support. Price will return to the breakout point, test it, find buyers defending it, and then move higher with conviction. This retest is your entry, not the initial breakout. At the retest, you have confirmation that the breakout level is real. Your stop loss is tight, just below the retest level. Your risk is minimal. Your edge is maximum. If price breaks out and never comes back to retest, that is the market telling you this was a genuine, powerful breakout driven by real institutional buying. In that case, wait for the first meaningful pullback rather than chasing the price. Patience eliminates false breakouts. Every single time. Trick #2, stop hunt. The market knows exactly where you are. This trick is so common, so systematic, and so perfectly executed that when you understand it, you will be genuinely shocked that you did not see it before. Here is the uncomfortable truth. The market knows where your stop loss is, not your specific stop loss. The market cannot read your individual order, but it knows where most traders put their stop losses, because most traders were taught the same things and place their stops in the same places, below recent lows, above recent highs, just outside of visible support and resistance levels. These predictable locations create what professional traders call liquidity pools, clusters of stop-loss orders sitting at similar price levels, waiting to be triggered. And triggering them is enormously profitable for the large players who have the capital to temporarily push price to those levels. Here is exactly how the stop hunt works. Price is in an uptrend. Retail traders are long, with their stop losses placed below the most recent swing low, exactly where they were taught to put them. A large institution wants to accumulate more long positions at a lower price, so they sell aggressively, pushing price down below that swing low. Retail stop losses are triggered. Those traders are now selling, exiting their longs. The institution buys those positions. Price immediately reverses and resumes the uptrend. The result? Retail traders were stopped out at the exact bottom of a temporary dip, only to watch price go exactly where they predicted, without them. If you have ever been stopped out at the precise low of a move before price reversed in your favor, you have been stop hunted. How to beat it? Give your stop losses room to breathe. Instead of placing your stop loss directly below a visible swing low, exactly where the stop hunt expects it, place it below the next significant level. Below a level where a stop hunt would have to extend significantly to reach you, making the manipulation too expensive for institutional players to execute profitably. Additionally, and this is critical, learn to recognize stop hunt candles. They have a specific signature, a sharp, sudden spike below or above a key level on high volume, immediately followed by a strong reversal candle in the opposite direction. When you see that signature, you are watching a stop hunt in real time, and the reversal that follows, that is often one of the highest probability trade entries available. The institution has finished accumulating. The retail traders have been flushed out. The real move is about to begin. Trick #3, the news trap. Emotion dressed as information. The news release hits. Non-farm payrolls, interest rate decision, GDP data, earnings report. The number is better than expected. Price surges. Every instinct you have screams, buy. The fundamentals are bullish. You buy. At the top of the spike, and price immediately reverses and destroys you. Welcome to the news trap, one of the most reliably profitable manipulation patterns in all of trading. Here is the mechanism. Before a major news release, institutional players have already positioned themselves based on their expectation of the outcome and the market's reaction to it. They are already long before the good news hits. When the good news is released, retail traders pile in, buying into the euphoria. Institutions sell their pre-positioned long positions into that retail buying. Price immediately collapses. The phrase, buy the rumor, sell the news, exists because this pattern has been repeating in financial markets for over a century. It is not a coincidence. It is not bad luck. It is the systematic transfer of money from emotional, reactive retail traders to prepared, calculated institutional ones. How to beat it? Never trade the initial spike on a news release. Never. Wait a minimum of 15 to 30 minutes after any major news event before considering a trade. By that time, the institutional selling, or buying, into the news reaction is complete. The false move has exhausted itself. The genuine direction, driven by actual supply and demand, rather than emotional reaction, begins to emerge. Additionally, learn to read price action before the news. If price has been consistently declining in the days before a positive news release, the market is often pricing in good news already. When the good news hits, and price doesn't rally strongly, or actually falls, that is a powerful signal that selling pressure is overwhelming the bullish news. Trade in the direction of price action, not in the direction of the headline. Trick #4, the trend continuation fake, trapping both sides. This is perhaps the most diabolical trick in the market's arsenal, because it does not just trap buyers or just trap sellers. It traps both simultaneously. Here is how it works. The market is in an uptrend. Price has been making higher highs and higher lows. Trend followers are long. Then price makes a significant pullback, deeper than the previous pullbacks, enough to shake the confidence of the bulls. Some of them exit. New bears, seeing what looks like a trend reversal, enter short positions. Then price reverses sharply and explodes to new highs. The bulls who exited on the pullback missed the continuation. The bears who shorted are now in losing positions and forced to buy to cover, adding more fuel to the upward move. The traders who held their long positions through the deep pullback are the only ones who profit. This pattern, the deep pullback within a trend, designed to shake out weak hands on both sides before continuing, is called a liquidity grab. And it happens with astonishing regularity in every trending market. How to beat it? The antidote to the liquidity grab is understanding trend structure at a deep level. In a genuine uptrend, even a deep pullback will maintain the pattern of higher lows. As long as price does not break below the previous significant higher low on a closing basis, the trend is intact. The pullback, no matter how frightening it feels, is a buying opportunity, not a reversal signal. The question to ask during any pullback is not, is this a reversal, but has the structure of the trend been broken? If price is pulling back but has not created a lower low below the previous swing low, the trend is intact. The pullback is the trap. And the traders who understand this are the ones collecting profits while everyone else is panicking. Trick #5. The slow grind. Death by 1,000 cuts. This is the most patient and most insidious trick of all, and it is the one that destroys more trading accounts than any other. The slow grind does not happen in a dramatic spike. It does not trigger your stop loss in a single violent move. It is gradual, almost imperceptible, and psychologically devastating precisely because it gives you hope at every step. Here is how it feels. You enter a trade. It moves against you, not sharply, but steadily. 10 pips. 20. You tell yourself it will recover. The fundamental case is still valid. The setup is still there. 30 pips against you. You adjust your stop lower to give the trade more room. 40 pips. You tell yourself this is just a temporary move. 50. 60. You have been in this trade for 3 days. It has moved against you steadily, without the sharp reversal that would trigger your stop and end the pain cleanly. Instead it grinds, and every small recovery, every 2-pip bounce in your direction, gives you just enough hope to stack, hold, until the loss is so large that cutting it becomes psychologically impossible. Until you are holding a position that is eating your account alive, unable to exit because the live pain of crystallizing a loss that large is worse, in the moment, than the continued pain of holding. This is the slow grind, and it kills accounts not in a moment of drama but in weeks of quiet, steady destruction. How to beat it? The only defense against the slow grind is a stop loss that you commit to before you enter the trade, and that you do not move under any circumstances. Not, I'll move my stop if the trade looks like it needs more room. That is the slow grind's invitation. A stop loss is not a flexible tool. It is a commitment made by your rational mind before the trade, designed to protect you from the irrational decisions your emotional mind will make during the trade. Set it. Honor it. Every time, without exception. A loss taken cleanly at your predefined stop is a controlled, professional outcome. A loss allowed to grow because you moved your stop is a psychological failure that compounds into a financial catastrophe. The market grinds against you because it knows that human beings find it harder to take a large loss than a small one. Your stop loss removes that weakness from the equation entirely. Trick #6. The mirror trap. Your own mind against you. The final trick is the most powerful of all, because it does not come from the market. It comes from inside you. Confirmation bias is the human brain's tendency to seek, interpret, and remember information in a way that confirms what it already believes. In trading, it is catastrophic. You decide you want to buy a particular asset. Immediately, your brain begins filtering information, unconsciously, automatically, without your permission. It notices every bullish signal. It discounts every bearish one. It finds the moving average that is sloping up and ignores the one that is sloping down. It reads the news headline that supports your thesis and skims over the one that contradicts it. By the time you enter the trade, you are not responding to objective market analysis. You are responding to a carefully curated selection of evidence that your own brain has assembled to justify a decision you had already made. The market then moves against you, not because your original idea was necessarily wrong, but because you entered based on incomplete, biased analysis that missed significant contrary evidence. How to beat it? Before every trade, spend 2 deliberate minutes building the strongest possible case against it. Not why might this trade fail, as a perfunctory checkbox. A genuine, committed effort to prove yourself wrong. Look for the bearish signals you might have discounted. Consider the scenario in which the trade loses. If I had no position in this asset right now, would I enter this trade based purely on what the chart is telling me? If the answer is yes, after honest self-examination, enter with confidence. If the answer is no, the confirmation bias was driving. Step away. This practice, genuine pre-trade adversarial thinking, is one of the most valuable disciplines any trader can develop. It will eliminate a significant percentage of the trades you currently take that should never be taken. The complete defense system. You now know every major trick the market uses. Let's build your complete defense. Against false breakouts, wait for the retest. Never enter on the initial candle. Against stop hunts, place stops beyond obvious levels. Recognize the spike and reverse signature. Use stop hunts as entry signals. Against the news trap, never trade the initial spike. Wait 15 to 30 minutes. Follow price action, not headlines. Against the trend continuation fake, trust the structure. As long as higher lows are intact, hold through the pullback. Against the slow grind, set your stop before entry. Never move it against your position. Honor it every single time. Against the mirror trap, build the case against every trade before you enter it. Be your own harshest critic. Conclusion: win the war. The market is not random. It is not chaos. It is a system. An extraordinarily complex system. But a system with patterns, behaviors, and psychological mechanisms that repeat with remarkable consistency. The traders who lose, the overwhelming majority, are those who fight the market on its terms. They react to its tricks with emotion. They fall into its traps with hope. They exit its false moves with fear. The traders who win are those who understand the game being played, who see the false breakout for what it is, who recognize the stop hunt in real time, who read the news trap before the spike, who hold through the grind because their structure analysis tells them the trend is intact. These traders do not have better indicators. They do not have secret strategies. They have something more valuable than both. They understand what the market is doing and why. Now so do you. The war is not over. But for the first time, you know your enemy. And that changes everything. Drop a comment below. Which of these 6 tricks has cost you the most money? Be honest. Your answer might help someone else. The market is a device for transferring money from the impatient to the patient. 3